So let me welcome you all to this great event, I'm sure. So Andrea, dear Andrea, I think we are very honored here at Bruegel to have you, and me in particular, I'm very pleased to see you. We haven't seen for a few years. We used to meet regularly in Frankfurt when both of us were associated with the ESRB. But from there, you went to great things. Recently, before you were at the BIS, you were on the board of
SNB.
The board of the Swiss National Bank. Very interesting period to be at the board. No, for 2 years already, right? You are the deputy managing director of the BIS. I think the highest BIS official to come and address us. So, in that sense, it's a very big honor. But not only it's an honor, it's a topic which is very important. I mean, all of us obviously are very occupied discussing the effects of the tariffs from the US, the implication for the trading system. But today we are going to hear a different angle. I would say, and we'll see from your presentation, a complementary angle, right? Another piece of the puzzle. Because indeed, it's not just about the trading system and the impact and relocation of goods and what real impact it has. Obviously, we are in a world indeed of high financial flows, and the US and the US dollar is the currency of the world. So it's not just tariffs; it's tariffs from the US. And it's tariff from the heart of the system. And maybe less the heart of the trading system, the heart of the financial system. So very much look forward to hear what are your views on the topic, what are the implications. And then very much look forward to hear from Peter Pratt.
I'm so curious.
Peter, who was, until not so long ago, the chief economist at the ECB. So we have really two highly qualified, wonderful people to talk to us about this. So Andrea will talk for about 20 minutes. Then Peter will give his comments. I suppose I will give a few comments on my own, and then we'll open the floor for discussion. Andrea, please, the floor is yours.
Merci, André. It's a great pleasure for me to be here at Bruegel. It is my first time, which is surprising, but a pleasure nonetheless. So Bruegel, of course, is very well known for its excellent analysis on macroeconomic and policy important topics. These include European and global perspectives on international finance, trade, and it has increasingly come together exactly for that, to discuss policy. Today, I want to explore the growing global financial ties that interconnect economies, investors, and markets. These ties have profound implications for the economic outlook, the way economies respond to shocks, and the formulation of policy responses. We live in an era of large supply headwinds, including the recent shock of trade tariffs. These shocks are complex because they affect the real economy through different channels on both the demand and the supply side of the economy. When the effects of tariffs resemble a supply shocks, limiting their inflationary impact to tighter monetary policy risks worsening the impact on growth. By contrast, monetary policy does not face such a trade-off for demand shocks as they push economic activity and prices in the same direction. The long-standing common prescription for central banks to look through supply shocks may no longer apply today, particularly with the inflation surge during the pandemic, which is still fresh in the minds of households and businesses. Central banks' responses today should be guided by the need to keep inflation expectations well anchored. And as financial factors can shape the impact of real shocks to the economy, policymakers must complement their assessment of the monetary and financial stability outlook with close consideration of financial linkages and the transmission to financial conditions. Indeed, the global economy is far more interconnected than when tariffs were last a prominent feature of trade many decades ago. Today, trade flows have been supported by long and complex supply chains that span the globe, but the world has also become highly interconnected through large financial capital flows. I have a picture for this. In the past, gross trade, which you see here in the red line, was similar in size to external financial liabilities, the blue line. So you can see this in the 80s all the way to mid-90s. Today, external financial flows dominate trade. Since the 1980s, when these both stood around 30% of world GDP, financial position today have grown to nearly 170% of GDP today, compared with 50% of GDP for trade. Understanding the web of financial interlinkages and the nature of large capital flows is critical for policymakers' assessment of macroeconomic and financial stability. A resilient banking system and buoyant financial markets have helped to buffer the economy from the expected negative impact of trade. So let me talk a little bit about the impact of the tariffs as a negative supply shock. This year, we have seen an increase in tariffs worldwide, which were largely expected to affect global trade, global growth, and create difficult policy trade-off for central banks. These tariffs came amid a prolonged period of uncertainty about trade policy. Today, various estimates suggest the US effective tariff rate has surged to a level not seen since the 1930s. And this is what you see. You have to look very closely on the left-hand side, the blue dot that really has jumped up from the red line. In theory, increased tariffs act as a negative supply shock for the imposing countries, in this case the US, and negative demand shock for targeted countries, including Europe. The interconnection of global supply chains with intermediate goods crossing borders multiple times and with firms' varying ability to divert the trade flows blurs the picture. In particular, disruption to supply chains and diversions of trade flows could have further effects on output and inflation, even beyond the direct effects of the tariffs. For central banks, calibrating the appropriate policy response to tariff and supply shocks more generally can be challenging. Why? Limiting the inflationary impact of tariffs through tighter monetary policy will add to the headwinds for economic growth, creating a difficult trade-off. Furthermore, as we know, monetary policy takes time to work its way through the economy. By the time it gains traction on inflation, the economy may have absorbed the shock, leaving only the negative impact on growth. As a result, as I mentioned earlier, a common prescription for central bank was to look through supply shock. Tariffs were expected to have only a one-off impact on the price level and thus a transitory rather than a permanent impact on the inflation rate. In other words, by waiting, central banks would allow inflationary pressures to abate without unnecessarily depressing growth. This look-through approach may no longer be effective, as central banks need to factor in many other moving parts when taking the policy decision. In the case of large and/or persistent shocks, there is heightened risk of de-anchoring inflation expectation. This risk is greater today against the backdrop of the recent inflation surge. Central banks need to continue to monitor closely the evolution of inflation dynamics in the face of such shocks and the risk to inflation expectation. So far, however, recent events have defied expectations. We have not observed a big impact from tariffs in the data. The underlying factors are difficult to disentangle and likely multifaceted. In fact, as we know, most macroeconomic models would have predicted that higher tariff imposed by the United States would lead to a slowdown in growth, especially in the US, an increase in inflation in tariff-imposing countries, and decreased trade. Recent work by my colleagues at the BIS show exactly that. This is an example of the model impact of the tariff shock: lower growth, higher prices, lower trade. However, the economic outcomes so far have been relatively mild. US manufacturing purchasing managers indices, the PMIs, turned down in April and in May. I also have, this is what you show on the left-hand side, turned down in April and May, but have since picked up also in Europe. Inflation largely remains in check. That's what you see in the middle panel. And goods trade has declined recently, but remains very much consistent with the levels typically seen in recent years. So why have we not seen bigger impact of economic activity so far? Of course, many factors are potentially at play. I want to emphasize the resilience of financial markets and the role of large global financial interconnection as key for understanding the full picture of the last 6 months. In fact, 3 factors stand out. First, sound banks helped absorb the economic shock by providing good access to finance amid uncertainty. Earlier speculation about US trade policy and trading relationship across the globe led many firms to preemptively secure access to credit. Firms worldwide increased their borrowing and access to credit lines in late 2025 and into 2025. These additional financial resources provided a buffer to help them manage the uncertainty. And when tariffs were announced and uncertainty spiked, many firms already had secure access to finance. This may be linked to the temporary increase in goods imports seen in the US. Firms front-loaded purchases to help smooth out possible tariff effect. Access to finance facilitates this kind of smoothing. This preemptive borrowing was only possible because banks were largely healthy and resilient. This echoes very much the pattern we saw in the aftermath of the COVID-19 shock. In part due to post-crisis regulatory reforms, banks have been a part of the solution to managing economic shocks rather than part of the problem. Second, monetary policy in major jurisdictions are on an easing path, particularly in those targeted by tariffs. Policy easing has supported investors' optimism by reducing the perceived likelihood of adverse scenarios. Third, the US dollar depreciated. You know this, but I do have a nice picture on this. This is what you see on the left-hand side. This is highly unusual, not only from a trade perspective, but also from a risk perspective. Standard macro models would predict that the dollar would appreciate after the US increased tariffs, as domestic consumers purchased fewer foreign goods. And from a risk perspective, a negative shock like the April tariff disruption is typically associated with a decline in risk-taking and a flight to safety to the US dollar. While financial markets were shaken initially, they quickly calmed and even turned buoyant, with credit spreads on high-yield bonds falling to nearly 20-year lows and market volatility declining. This is what I'm showing here on the right-hand side. The channels through which a weaker dollar affects the real economy are many. But in the recent episode, the weaker US dollar was an important factor offsetting the tariff shock for the global economy. Let me explain. A lower US dollar can drive greater global financial and real activity, as documented by BIS researchers and others. As the dollar depreciates, the value on non-dollar assets rises compared with dollar liabilities. This strengthens the balance sheet and returns of dollar-based global investors and increases the risk appetite. Foreign investors increase lending, easing financial conditions. Second, for countries targeted by tariffs, a depreciating dollar puts downward pressure on local currency import prices and hence on domestic inflation, as seen in Europe. This in turn increases the scope for monetary policy easing to partly counteract tariffs' negative impact on their competitiveness and growth. But these reflections really beg the question, why did the dollar depreciate in the first place? Financial drivers again played a key role. The US dollar exchange rate did not appreciate as suggested by standard trade models, which would have upset the price effects in the imposing country and helped soften the loss of competitiveness in the targeted countries. Rather, it was financial channels that led to a US dollar depreciation. And a key driver appears to have been investors' reevaluation of the dollar's hedging properties. Usually, the dollar provides good insurance against global downturns, so some investors hold long dollar position. This was particularly true in Asia, where investors had open long US dollar exposure, which they sought to hedge after the fact. When the tariff shock arose, they entered into FX forward to offset these open positions, driving down demand for the dollar. The cost for hedging dollars, as reflected by the cross-currency basis against the dollar, that's the first panel that you see, increased for Asian currency the most. And most of the dollar's depreciation in April and May occurred during Asian trading hours. That's what you see in the second panels, where in April, much of the change in the dollar index actually happened against Asian currencies. But then, given the continued strong performance of the US assets and the unrivaled depth of US financial markets, foreign investors did not appreciably sell the US positions, but rather they used derivatives to reduce their open dollar exposure. In other words, the US dollar move was driven less by financial flows than by a reassessment of investors' willingness to pay for hedging the existing position against US dollar volatility. And given the prominence of financial factors in driving outcomes over the past 6 months, let me delve a little bit deeper in how the rise in capital flow may have contributed to the depth of these financial linkages that we see today. The latest BIS annual economic report highlighted 2 key long-term developments that have reshaped the financial system and its interconnection. First, something we all know well, there has been a huge growth of sovereign debt markets, tilting the share of credit towards the public sector. I want to focus on the other side of this development. There has been a strong growth in bond holdings, increasingly held by a different set of actors, institutional investors and other non-bank financial institutions, rather than banks. The growing size of bond portfolio held by institutional investors has increased the need for asset diversification across countries, hence making the financial system highly interconnected. This is what I show in this graph. The graph shows the change in cross-border bond holdings of private investors from 2015 to 2023. The thicker lines mean larger increases and gray lines mean decreases. As you can see, there's a lot of blue lines, there's very few gray lines. And these interlinkages have strengthened globally, even if they grew especially vis-à-vis the US and Europe. And second, large bondholders also sought to optimize the returns of their portfolios by insuring against FX volatility. This is reflected in a very important development, namely the commensurate increase in the FX swap market. FX swap markets are important because they allow institutional investors to hold cross-currency bonds on a hedged basis, facilitating increased access to the universe of assets across the world. This is what I'm showing here. This is where you see the size of the FX swap market. When you look at the data, two observations come out. First, the FX swap market has the US dollar as its core. Of the 111 trillion, which is the aggregate size of the market, 98 trillion have the US dollar on one leg of the transactions. This is what you see on the left-hand side with the red bars. So that means every swap is made, well, not every, but 90% of the swaps are made against the dollar. And the second important fact is what you see on the right-hand side is the depth of the FX swap market is central in fostering today's complex network of financial interlinkages. The size of the FX swap market went from 50% of global GDP in 2000 to 100% today, creating an even larger set of international financial links than the growth of external liabilities I showed earlier. Institutional investors account for a large share of the FX swap contracts. This is what you see with the red bars on the right-hand side. So today's deep cross-border financial links, including through bonds, derivatives, and other instruments, mean that shifts in financial condition can strongly influence economic conditions, even during major trade disruptions. This is because changes in investor risk appetite or balance sheet constraints can trigger shifts in capital flows, cross-currency investments, and hedging demand. These shifts can serve, for example, as powerful drivers for short-term exchange rate dynamics and for financial conditions more generally. Recent BIS work indicates that domestic financial conditions have become more sensitive to global shocks, including those originating abroad. Let me conclude. I have argued that financial factors play a crucial role in understanding the impact of tariffs on the real economy. Financial markets can either help mitigate or amplify economic shocks. Resilient banks and buoyant risk markets help to buffer the negative effects of the recent tariffs and associated uncertainty. But a deterioration in asset markets and tighter credit conditions could also expose vulnerabilities. This underscores how crucial it is that we better understand the exposures, hedging, and leverage of institutional investors and other bondholders. In a different context, they might have accelerated the shock, tightening credit exactly when firms needed it most, leading to cascading shocks throughout supply chains and credit markets. Their response to different shocks and their liquidity needs under stress are key for financial stability consideration. International cooperation can play an important role in effectively monitoring financial vulnerabilities. And what does this mean for monetary policy? Policymakers must carefully balance supporting growth with preventing temporary price increases from turning into persistent inflation. And as financial market sentiment can shape the impact of real shocks to the economy, policymakers must complement their assessment of economic activity with a close consideration of financial linkages and their transmission to financial conditions. Fostering a better understanding of how these financial linkages may influence inflation expectation will help central banks determine when and how to look through a given shock. As complicated economic situations seem to be the new normal, central banks do not have an easy task ahead of them. Large and growing financial interlinkages add to this challenge. A watchful eye on the financial system, both at home and abroad, is crucial to sound policy making. Thank you.
Thank you. No, it's not working. Anyway, thank you, Andrea. I think this was a great presentation. I've a number of questions, but first let Peter bring his remarks. Peter.
Yeah, thank you, Andrea. Last time was in Paris at the OECD WP3. We were with Trump 1 environment, and so we got a taste, of what would come later, but we didn't imagine that it would be, what we witnessed today, far away. So we thought it was a transition and relatively limited sort of regime change, in policy. Now, of course, situation is quite different. I think if it was only tariffs without reciprocity, it would be so easy. Now what you try to explain, we have a very interconnected financial system, and I find a little bit the arguments that we are so interconnected that it's a strong incentive to cooperate in crisis, in difficult times. Now, I'm not sure that that would be the case. How would cooperation work in a context of political priority, America first? So we had already with Lehman Brothers a number of avant-goût about difficulties of cooperation. Then we tried, to address some of these issues, and the FSB, and all that cooperative framework, where the BIS plays a key role. No, I'm not sure what would be the attitude of authorities. So the fact that we are more interconnected, like in trade, would make trade wars, and things unlikely because we have too much, each side has too much to lose. I don't know today. And that's a zero-sum sort of mentality. So that's my first observation. The second observation, it is clear that tariffs are only a little piece of a toolbox of economic and political tools, a little piece that are designed for political objectives. And to get what? To get concessions, to extract, I would say, concessions for from other countries. And so, yes, the big surprise, as you say, was that our economies proved to be resilient. And for how long, I don't know. But so you try to explain why this resiliency. I mean, take one example. The balance sheets of the private sector are quite solid today. But they're quite solid, so that helps, both in the US, in Europe, and elsewhere, households and firms. And that allows you to absorb some of the shocks, including banks, by the way. You mentioned banks, they're much better capitalized, so there is no credit crunch and all that. But at the same time, the strength of private sector balance sheet, and you mentioned that, the mirror of that is the contrary on public finances, because most of the recent shocks we had since the global financial crisis has been absorbed to a large degree by public finances. And so I always think it amazing to say that private sector balance sheets are sound. When the public sector are unsound, there must be a link between the two. And we see the tensions on public finance are increasing everywhere. So that's my second observation. So resilience may be on the surface, but the weak link may be, as you mentioned, public finances in general. A third thing, I repeat maybe the beginning, but we have a regime change. So it's totally different environment than what we had before. So I think the regime change is a sort of zero-sum gaining, and where you mix political, economic considerations. For example, our reactions in Europe to the US, without Russia invading Ukraine, would have been different, frankly. And what we have seen with the tariffs, we say, it reduces uncertainty. I don't think it reduces uncertainty. It makes me more certain that there will be other things to come. And the discussion about data protection, all that data, ownership of data, and it's only the beginning of a new conflict that we're going to have with the US. I'm not mentioning China and all the other problems. How should central banks react to that? They're very worried. In the beginning, it was easy, as you, in a very good speech you made a year ago, I think it was about a year ago, about supply shocks. All supply shocks are not the same. I summarize all this that the aggregate supply curve worldwide is more inelastic because there are more frictions everywhere, more inelastic and more volatile, with the dominance of negative supply shocks, because also the AI and technological shock that brings the supply curve. How should central bank react to that? It's relatively easy, as you say. You build maximum credibility. Sometimes you have to be a bit hawkish if you lost credibility, to have maximum so that you can look through to some degree on these things. I mean, relatively simple. But in the environment that we know today, it's very difficult to tell. I don't know how the US Federal Reserve will evolve. There was a very good speech, very interesting, good, I don't know, but very interesting speech by Scott Bessent recently. I mean, bashing QE, for example, which I'm used to that. But I wonder if you hit the lower bound, central banks, again, bashing QE means that you're not ready to go in again, because you criticize that, and we see if Kevin Walsh becomes president, would be quite challenging. There are other better names, but that will be a key signals we'll see in the markets. But again, if you bash forward guidance, you bash negative rates, you bash QE, what do you do in case? I mean, just a simple example. So central bankers like to keep options open, admit that maybe, QE was too long, you should have exited faster, maybe you should have bought, extreme long duration on the balance sheet, there must be more coordination with the debt management office and things like this. All these are interesting criticism. But the speeches you see today close a number of options, in case of shock. Another example is dollar swaps that you mentioned, very important, of course, in the stability of the system. The US have special responsibility in ensuring, as you said, orderly liquidity conditions worldwide. That's a high responsibility. But when I hear the US saying that the exorbitant privilege is considered as free riding by the others on a common good, so we free ride on the dollar, and at the same time when the US use the dollar as a weapon to extract political concessions. And more, not less and less, but more and more. So I mean, the environment that we described means that the central banks, especially I would say from the European parts, are in a very difficult position. So we will see the signals in the US, but the Scott Bessent speech bashing QE, I mean, we are used to that. I don't think it's very clever to do that, but at the same time, he wants an independent assessment of many things in the Fed, including research, including the SAF. I mentioned to you, Andrea, that years ago when I was in the same plane as Lamfalussy, he was insisting so much about the quality of the staff of the BIS and the research, analytical independence, etc. of the staff. He said this is key, absolutely. What you see, this independent assessment of the staff and research, I think this is quite something. The bashing QE, I'm used to that. I think it's unfortunate because the day you use it, what are you going to do? But this attack, because nobody believes, of course, that there will be an independent assessment of the staff of the central bank in the US. So there are many challenges. That means that Europe has to be strong, etc. But that's for André. What are the options for the future? Tu veux que je continue or No, I know it. Okay, then you continue, and then maybe we...
No, I don't want to continue. I just want to maybe put one... I think Peter has really put a lot of excellent questions. I think not easy questions. I will just maybe add one element, but basically rephrasing in a sense what he said, or my understanding of what he said, and I would use the word regime change. So in my very short introduction, I mentioned the fact that our discussion today is not just about the impact of tariffs, it's the impact of tariff by the country, which is the center of the economic system, and even more than the trading system, the heart of the financial system, right? And the presentation is very much, can be read in two manners. One more optimistic, sort of the resiliency part. The other one is, wow, the trading system is under attack, but maybe the financial system itself, because of where it comes from, is under attack or is under uncertainty. So yes, one side is resiliency. The financial system has the capability, and indeed, because we had a financial crisis not so long ago, the banks are well capitalized. The system has sort of incorporated the dangers, but when the shock comes from the heart of the financial system, and we don't know what's happening with the Federal Reserve and all of those elements, then naturally, I think that's what Peter is saying. One can see the other side of this. Rather than optimistic, one can be worried about this. So I think it would be good to hear from you. What is your assessment of the plus? Okay, the plus is the easy part, and what is it that you are, or the BIS is recommending to countries in this circumstance? Okay, we have to be worried indeed about the dollar swaps. We know how important the dollar swaps were in the financial crisis, even in the sovereign debt crisis, right? The dollar swaps were super important. Now it's become a bit of a question mark. Doesn't mean it won't happen, but we are less sure. So what is your recommendation? Yes, cooperation, but if cooperation from the US is not forthcoming, how should we, the rest of us, behave?
So, always very good question, André. The question is, for us, it's first you need to be able to give credit to the system. There has been tremendous resilience. There was already tremendous resilience, remember, when the central bank had to really tighten the monetary policy. There was a soft landing. Now we have a big new shock, incredible resilience. And we need to give the credit to the regulators, to what has been done, to why the banks are in good shape. Private sector, you're right, there's the public-private. The BIS, like most central bankers, were paid to worry. We're paid to look at the risk, right? So of course, we're going to look at, okay, is that now a structural change that the world can react to any shock? And our response is clearly no, right? There's certain factors that have made that reaction possible. There's many on the macro side. I'm not saying it's all driven by the financial side, right? The supply chain, the ability to divert trade, all of this. But I think what we are really pointing out is there might be, suddenly when the dust settled, there's certain things we may not have appreciated the way they have evolved. And one of them is how the capital market, how the financial system has evolved, and how you've had a huge increase in assets and financial assets. Those needed to be invested, to be diversified. So all of these asset managers, institutional investors are doing a really good job optimizing risk return, but it has meant you had to go beyond your own borders, and you've had to hedge certain risk. And so you have a huge amount of financial linkages, which is, for an economist, this is a good thing, right? This is diversification at its best. The issue is it can also revert. And when we know that it's a market sentiment, it can revert very quickly. So I think so our message is really, we need to be careful, and we need to have a system that is not only resilient in the good time when you have good financial condition, but that we can also react when that changes. And look, is there a magic wand we can use? Absolutely not. But one of the things is how important it is to understand the mechanics. The hedging is a good issue, right? There's nothing magic about the hedging. But it's not a straightforward data where you can download the page, get exactly the position on an unhedged way, the position on a hedged way. So what we're saying is how important it is to continue to do analysis, to understand reaction functions, to understand linkages, in order, and because and that's where I'll end, is what does it mean for central banks? Central banks have a domestic mandate to maintain financial monetary price stability, financial stability as well by price. But they cannot, in today's world, fulfill that mandate unless global markets function appropriately, which is what you said at the beginning. And I think this is the point here, is that there is a need to work together, and the financial sector has really grown to a level we may not really internalize to what it is. That would be my message.
Can I open the room for discussion? Ivo, then Nicolas. Can a microphone? Yes. So we'll collect 3-4 questions. Please, Ivo.
Ivo Maas, Bruegel. I have a question about the bond market vigilantes. And in a sense, here the message is the financial system was resilient. Was it maybe not too much resilient? Is it not underpricing the risk which Trump is posing? And so, yeah, that's my question.
Okay. We take 2-3 questions, if you don't mind. Nicolas Véron.
Thank you, Nicolas Véron, here at Bruegel, also at Peterson Institute. Question to you, Andrea. I want to connect what you said about with the debate that is going on in Europe about possible revision of capital requirements on banks. You know, we have all these conversations about simplifications. The US may be deregulating. They're loosening the supplementary leverage ratio. Should we do something in parallel? You're very aware of those conversations. Now, part of your story is that banks are well capitalized, and therefore they could provide credit in a way that was not pro-cyclical. So how does your story read across to the story about capital requirements? Of course, you're not talking on behalf of the Basel Committee, but you're in Basel. And therefore, how do you see those discussions being connected or not? Thank you.
Yes, please.
Thank you very much, Bernard Snow, Robert Triffin International. You talked about the depreciation of the dollar. The question is the starting point. Do you agree with the view that was expressed by Stephen Miran, the chairman of the President's Group of Economic Advisors, that the dollar was overvalued to start with, but overvalued because of the Triffin dilemma, which is acknowledged in the Stephen Miran memorandum, starting from the worldwide demand for dollar-safe assets, which is the consequence of the dollar's role as the global currency. Thank you.
Andrea, please.
I'll start, and Peter, I'll throw it to you as well. Let me take them in the order. So risk underpricing, look, that is a great question, right? And I think it is another, the many puzzles. One of them is the difference between the really loose, easy financial conditions and the hard data. Underpricing is always something that's empirically not easy. So just to make sure, what I looked at, and it's on purpose, I'm looking at the bond market, right? And I've also shown a graph where you see credit spread have really down record low. You know, so that's it's a very difficult question to answer. My point is to recognize, to try to understand what is it that drives. An equity market is a different one, right? But we've always seen this disconnect. We've seen it between hard data and financial. We've seen it between equity market and bond market. Right now, everything seems to go in the same direction. The point for me is not to be here to tell the market how to price the risk. The point is we need to be able to, the world needs to be resilient when it changes. And so we need to make sure we have a system where the people who take the risk can bear the risks. And that's really the difficult part. And I think this is where these financial linkages play a role. Because then it means, because everything can happen so much faster with such larger volatility that it's hard to know what is the risk I should bear as an individual investor. I think this is where we're kind of getting it, is how do you, again, like before the global financial crisis, how do you think about these systemic risks that are really difficult to price? And I think these are some of the issues. Bank capital regulation. Look, I mean, the point is, I want to come back to some basics on this, because as you can imagine, I'm not going to tread too very carefully in the political questions. But the point is, what we have seen, once again, we've seen it during the COVID crisis, we've seen it now, how important it is to have a solid banking system, okay? That is hands down. If we had a problem there, I mean, think COVID was the same thing. If we had had a weak banking system, it would have been very difficult. Then the empirical evidence is not clear that the capital requirement has majorly made financial intermediation by banks difficult, right? So now, that doesn't mean that every regulatory system needs to be regularly reassessed, looked at, and seen where are things that can be simplified. So I think it's a healthy exercise to do, but I do think in the end we need a solid banking system, whatever, you know, but solid also means it needs to be a smart regulation, and I think from that perspective, it's very good to do the work that is happening. To me, let's go one step further. We need a solid banking system because it is at the core. Because now we have, as I've seen it, the growth of the non-banks, right? And we know we don't have the same data, we don't have the same supervision of them. There's a lot of risk there. And now you can even go one step further. We have crypto. You know, maybe a year ago we'd have said, well, crypto is a speculative asset, who cares? Well, right now, crypto with stable coin reopens the whole question of another yet set of asset classes. So I think, look, let's keep a really solid banking system, and let's make sure, of course, we need to have a level playing field across the sectors, and I'll come back to risk. What we need to make sure is whoever takes the risk can bear the risk, which is a really difficult thing to evaluate. And last but not least, US dollar. Do I agree with Miran? I don't need to answer that question. But the point is, Triffin, is it because of the Triffin dilemma? I think the point is, and this is what I'm trying to show here, the US dollar is at the core of the financial system currently. And I think we may have not understood to what extent it is. Now, is it a safe, so it is because of its safe asset function. But I think it goes together with, it makes sense economically. Right now, whether we want it or not, where do you find the strongest market, the strongest economy? The highest returns are US dollar denominated assets. And then you don't only need assets, you need the ability to manage them. You need deep markets. Where do you find the deepest markets? In the US. So far, you had rule of law on top of it. You know, that's a different issue. But what I'm saying is that, so it's not only a political a gesture that there's been an overweight into US dollar asset. It was because the markets function, but there is a little bit of it, right? You have a lot of assets, you develop other markets. But I think it is important to understand it's not just political, it's also the economic reality of it that makes the dollar have the function that it does in the current system. I hope that answers. And
so the fundamentals matter. That's what you just say, no?
Absolutely.
And that's where I'm worried. I think the US economic policy in general is unsustainable. So there will be a shock. I don't know exactly how, but there will be a major shock. And then all what we describe as an interconnected, resilient system, well, there's a kind of contradiction because we try to reduce interconnections in the financial system across banks. But as you know, the connections are with non-banks. To some extent, they're lesser leveraged than the banks, so that's positive. But as you know, there is a lot of hidden leverage. There's a lot on private markets now. And so I think without a regime change in the US, which erodes trust in the counterparty, that would be manageable, I think. But the two together is very worrisome. Okay, so I think if there is a shock and we have a sort of very cooperative sort of attitude, I think, okay, one can manage. I'm not so sure in a much more, devices sort of cooperation framework.
Other questions? Don't be shy. No?
No. If there are no questions, the question you mentioned, the SEC in the US and other places, but it's quite important. You mentioned crypto, of course, so they want to go very quickly in the golden age of crypto. If you read the last speech of Atkins, what is his first name? Mark? Paul Atkins. So he came back. So he's now a very, very interesting speech, a few pages. Crypto, the golden age is coming. So I think that reminds us, the time when I was very often in the BIS. And it goes very quickly, as you said, very, very quickly. And the second part is what he says, which is interesting about accounting. Because, I don't know, Nicolas, you saw that. He threatens European firms by saying, we accept IFRS, but if you do this sustainability reporting with double materiality, we may reject it, and you will have to go to US GAAP. I mean, simple things like this. I mean, and it's using threats to impose your views, the views of the world to the rest. I mean, this cannot, be conducive to cooperative attitudes in general. So it's everywhere. You see that everywhere in all parts of the system, not only in the financial system. Everywhere you see that. Look at the distinction between Argentina and Brazil, most favorite nation. I mean, it's almost a case, of a caricature of and that's a leader. That's a leader economy in the world. So there will be a shock at some point. So we don't know exactly how it's going to come, but there will be a shock, and we better be ready, of course. But I'm not so sure, you see, that our financial system will be so resilient. Because, as you know, I mean, the BIS has produced a lot of work about hidden leverage. The Archegos was a fantastic case, I think, of experience. I don't know if the Archegos risks are still under control when I see the SEC putting a lot of bad will, to cooperate in terms of data requirements about leverage of on exposures vis-à-vis non-bank hedge funds in particular, non-bank financial institutions, etc., etc. So I think on surface it looks fine, and you're right. I mean, so far so good, which could have been much worse. I fully agree with what you say, but I don't take much comfort, given crazy policies that you have in the US. And I mean it. I mean,
but that would be the message from the speech, right? I mean, we're in the
you
soft
have to be careful.
spot.
You have to be careful.
Yeah, we're in a soft spot. But I think it is linked. The issue is they're difficult to assess, and I think that's why we need to do much more work on them.
Can I add an angle to this? So I think one of the themes, again, if I can put add words to what you said, Peter, and that personally I would agree. If we could count on cooperation, then I think would be in good shape, right? Then indeed, what we have seen in recent months and the less negative impact than one has observed so far, the resiliency partly coming through the financial sector would reassure us, because we know that down the road there could be cooperation. If, on the other hand, one is less confident of the cooperation, and I think it's a fair assumption. We could be surprised, obviously, and that cooperation is needed also from the US side. that the damage would be everywhere, including for the US, and therefore cooperation is needed. It's not a question of a choice. It's a necessity. But if for some reason this cooperation is not sufficient, then sure we have to be more on our guard than one would otherwise. Then my question. So if the international dimension of this is less is more doubtful, then we have to rely more on ourselves. And then the question is, in what manner? In what manner? And I don't want to go about simply the euro. I mean, it's a question of for the rest of the world. And I wanted to bring a dimension that we have not yet really discussed, and that brings us back to where we met initially in Frankfurt at the ESRB, macroprudential. What role do you see for macro? To me, everything that I heard cries of macroprudential, right? Because of all the other dimension, the non-bank, the crypto, all of those elements means, wow, there is a lot of interconnection, but not just internationally, across all kinds of asset classes. And to me, that's, macroprudential. So is our macroprudential system, I'm not talking in Europe, but I'm talking in general, is our macroprudential system, have we made a lot of progress since the financial crisis, in your view? And are we well equipped? Are we well aware of those interconnected risks? We know that the data is always, okay, for banks we have good data, for the other sides not so good. So what is your comment on that?
So are we well equipped? Clearly, there's a lot more to be done. Are we as an international community looking at it? Absolutely. I mean, there's a lot of efforts underway. So one is that focus on the NBFIs, and also the FSB continues to do really good work on it, and to continue to focus on what can we do to make sure, because as you mentioned, I've been focusing on the bondholder, but there's a whole private markets as well. There's hedge fund. There's a lot of actors in that field that have a very different way of functioning. Private markets are very opaque. And then, as I mentioned, right, there's this new area that is opening up with this, which is crypto, that may come through stable coins. So there's a lot of work that is happening on trying to put the hands on and to understand the dynamics. So the FSB, as I say, does a lot of work on it. The Financial Stability Institute has done analysis. And the one thing I want to add also on the crypto world, on these new technologies, also technology is very important. Because, for instance, the development of crypto, it's very difficult. You need to use very different monitoring tools to have a sense of what's happening. So, for instance, there are tools that are being developed to try to monitor the developments.
It's good we have the BIS. I mean, really.
Well, I wasn't going to.
No, but I really mean.
I wasn't going to, because
you just said why. I mean, I think that's a core institution in the environment we describe.
Exactly. So we need both. We need to understand the macro questions, and it is macro, but the PRU comes from bottom up, right? You need to go to institutions. The issue with the new technology, whether it's blockchain, DLT platforms, whether it's in crypto, or whether it's they're very different animals. It started after the global financial crisis. Even asset managers are very different animals than a bank. So you need to think, how do you even think about the incentives? How do you think of who holds the risk? And how do you think about the risk absorption capacity? So are we well equipped yet? There's lots of room for improvement. Is the work done? Absolutely. Is it done seriously? Absolutely. And I think it is, and you're absolutely right. I mean, that was the whole question on risk taking. Ultimately, it is a macro perspective, is making sure that the individual actors understand not only what they see as the single risk, but also integrate the impact that a much broader crisis would have.
So in this context, we will see if the US Fed loses the supervision of banks, which will be interesting to follow.
I think we can conclude here. I'm really grateful to you, but to you also, to you, Andre, and to you also, Peter, for bringing this discussion here. As I said at the start, I mean, too often when we discuss tariff, we are bogged down into the real side, and as we have seen, the real side effects have not been that important. I also think that the real risk are here. So as I said, there's the resiliency so far, but there are the potential risk down the road, and I think the discussion that you have brought here, and that you also, Peter, have emphasized, sort of have made us maybe more aware of the interconnection. I think your first graph was really very, very useful, right? Where you show the trade, you know, when people like me, from the trade side, we don't show the two, right? We show only the red one. Then you start to see the details, and you say, well, you know, deglobalization, all of those things. When you put it against the financial flows, the red line has barely moved, in fact. It continues to rise, right? When you look from close, you see a bit what's happening. So I think it was very nice to start your presentation with the trade flows, and then the financial flows, and then gives a completely. It's a simple graph.
Simple graphs.
Yes, but simple graph, but extremely telling. So the story needs to have those two graphs, and I'm very grateful for you to have done that, and that sort of shedding light on a different side of this very, very complex story, of which maybe we only at the start. So thank you again for coming, and thank you, Peter, as well. And thanks for everybody. Thanks.